Okay. 1, 2, 3. Okay, perfect. I think we are online to today's panel discussion. Today I have again 4 wonderful guests here. Valentin Kalinov from ITSA, Masoud Sultan from the Frankfurt School Blockchain Center, Marcel Grimm from Decentralized Capital, and Thomas Faber from Rudy Capital. And our topic for today will be yields in DeFi. I guess with the audience, it's already quite known that yields in DeFi can be quite high. Sometimes we see yields of about 100, 150%. Last summer, for example, also with Olympus DAO was up to 50,000%. And today, during this panel discussion, we would like to dig a bit deeper in why are the yields so high and what are actually like some kind of component of the yield and what are the differences. And for that, I would kindly ask our 4 guests with a quick introduction round, just briefly explain who you are, what you do, and maybe also shortly how you got in contact with crypto. I would ask maybe Thomas to start.
Yeah, sure. Thanks for having me on the panel today. Was really nice talking to all of you in the last panel. Some of you are here again, so really looking forward to this. Yeah, I'm co-founder and chief investment officer of Rudy Capital. We, in short, want to make DeFi investable for traditional finance players, but also for private people in the future. And for that, we conduct in-depth market research, build risk and return models for this new world, and also simulate and model all kinds of different portfolio allocations with a specific focus on market neutral strategies. And yeah, as for myself, I have a management and finance background, worked for Professor Santner at the Frankfurt School Blockchain Center for a couple of years, have also been part of the ITSA. And yeah, I think my story of how I actually got in touch with crypto is not very special because it was simply about Bitcoin in about 2016, 2017, like probably for 95% of the people.
Perfect. Thank you, Thomas. Then next, Marcel.
Happy to be here today. I came into the market 2018, May 2018, maybe in the last bear market was my start in the crypto scene. And nowadays, I'm a digital asset consultant at APR. I'm an analyst at Decentralized Capital. I'm a digital assets consultant on my own, so I have an own company founded in that kind of area. And the well-known DeFi Talents program, I'm supporting and managing that program. I'm a mentor at the moment at this program. And last but not least, I'm an organizer of blockchain meetups in Frankfurt. So if you're interested in a meeting in person, today's session is online. Yeah, you can reach out to me. There are a lot of opportunities.
Great, thank you, Marcel. Maybe I even take advantage of that in the future. Then next we have Masoud.
Yeah, hello everyone. Thanks for having me in the panel today. My name is Masoud Zultan, been in the consulting space since a couple of years and generally exposed to the blockchain space since 2017. And currently I'm a research assistant and project manager at the Frankfurt School Blockchain Center. They're supporting and managing projects like the DeFi Talents program or supporting DSC, which is a consortia of leading universities and institutions researching and teaching DLT, and also in other blockchain-related consulting projects.
Thank you, Masoud. And then last, Valentin, please.
Hello, everyone. Thanks for having me again, Christian. I'm an executive director at the ITSA, and we are a nonprofit based in Berlin, where we focus on identifying, classifying tokens and storing these in a database and sharing it with the community. We have also open access. So if you're interested to test out what we do, you can go on our website and check it out. How I came into crypto, maybe it's interesting story. I was in university visiting some interesting blockchain course in 2016, and nobody cared about that back then. And my professor then told me, why don't you come to Berlin and do an internship at a local startup educating people about smart contracts? So this is where it all started, in Berlin at the Ethereum office. And later on, there is a known book called Token Economy, which is partially summary of what we did. Of course, the author expanded much more on that. And yeah, the journey has been going on since then, and I'm part of the ITSA now. Yep.
Perfect. Thank you, Valentin. Yeah, actually, like I've also read the book. So if there's any like beginners also listening or tuning in today, I can really recommend it. It's called Token Economy. I'm not sure if it's also available in German, but I think it is or will be translated very.
It's translated in German, and actually, if you volunteer, you can translate it in your own language and publish it and get a cut from the fee, from the sales.
Okay. Perfect. Okay, then let's directly dive in. Our topic for today is a DeFi yield, and also why are they so high? I would like to start with a very simple first question, and that is, what are like the most common ways to obtain yield in DeFi? So as an investor, what are my possibilities of deploying capital?
Yeah, sorry, I can start off.
Yeah.
So I think the most popular ones are definitely lending, liquidity provision, and staking. So lending would probably be the easiest one, right? Because interfaces have become very easy to use. It's easily accessible if you know how to create a wallet and how to manage transactions. So yeah, lending has become pretty popular. Liquidity provision is a bit more complex because the market is a bit more fragmented. You have all kind of different liquidity pools. You have just decentralized exchanges that function a little bit different. But that would still be, I would say, the second most popular, maybe on pair with staking then. And staking, of course, has also become very popular with all those providers rising, such as Lido, for example, for liquid staking. So you don't have to lock your tokens for a certain time. You become more liquid. Also, some more risks on the table, right? We can talk about that maybe later on. But I would say in general, those are the three categories that are most popular and very well known among investors.
Mm-hmm. And you're absolutely right, because about staking, we will also touch on that later, because there's also different concepts on regard to tokenomics and how I can stake tokens. There's like a lot of new concepts constantly being developed. But now let's already go to the next question. Where does the yield that liquidity providers, or let's say lenders or stakers, that they obtain, where does this yield in DeFi actually come from?
So I think yield can be categorized in many types, but three broad types of yield in the market, actually. And the first being leverage or demand for leverage. So this relates also strongly to the traditional finance markets, for example, the commodity market, like, for example, the cash and carry strategy, where a trader or protocol will buy one digital asset and then open short position for the same amount. And if the asset goes up or down, they're hedged, so it doesn't matter. And they collect the funding rate premium. And we have seen actually that the demand and leverage is very high in the crypto space. So people are borrowing stable coins or providing BTC or ETH as a collateral, and or via buying futures and getting leverage exposure. And we are seeing the dollar yields that are over, for example, 15% and sometimes over 100%. And this demand has been astronomical in the last bull market. And actually, where does this come from? So, for example, when there's big leverage bias on an exchange, the cost for leverage will go up. And through the cost going up, people will come and arbitrage it. And people will buy, for example, BTC, USD spot, and then they sell the derivative that is paying a lot of funding, and then they lock that in. And that incrementally pushes up the cost of dollars everywhere, because dollars are flowing from one exchange to another, and dollars generally flow to what the market with the highest yield will get, right? So this would be one source of yield. And then we have the second category, which will be the reward in the native token in DeFi. And this is when people are using the DeFi protocol, whether that's supplying liquidity or trading on it, they're receiving the native asset of the protocol. So percentage of the network by participating in it. And they are giving tokens, so they are given tokens as the protocol grows. And it's helping bootstrap the network. And an example would be, for example, Compound, which is supplying tokens by supplying tokens to Compound and earning Comp token. And the third category would be, I think, the reward for profitable protocol activity. Like, for example, SushiSwap and Banco are paying profits from the underlying protocol. It's like owning equity. And I think this is one of the most sustainable and what is called right now real yield, which is a narrative that is popping up at the moment. But I think we will talk about it later. So that's, in my opinion, the three sources of yield. Maybe someone has to add something.
Maybe adding a little bit more on the staking part, where I think we generally have three types of staking. We have voting escrow, where you stake your tokens and you can vote, and you can also earn yields on that. And if you have also the type of staking where you earn dividends, basically. So you only earn the dividends after you stake your token for like certain time. And then you have also insurance. It's not involved in yield, but it's also insurance if something goes wrong. This is how you for example, on synthetics or DYDX, you can ensure that you don't lose too much money in the markets. Yeah.
Yeah, Valentin, just shortly, because I think vote escrow is already quite technical term. Could you just briefly explain what the difference is between regular staking and vote escrow?
Yeah. So in general, if you're a token holder, you stake or lock the tokens in a vault for a specific amount of time, let's say. And the longer the lockup period leads to more rewards and greater voting power for you as a voter. So this is the general description of it in my mind. Yeah.
Mm-hmm. So basically, if I provide my liquidity for a longer period of time, so it's basically more sticky. So basically, it's better for the protocol because it's easier to also plan for the future. Basically, I get rewarded with a higher return, right?
Yeah, the idea is to incentivize you to not move your tokens, maybe sell them or something to keep the supply of the exchanges where you can, the idea is to not push the price downwards. So the longer you stake, you should be rewarded with higher yields. Yeah.
Mm-hmm. Perfect. Yeah, actually, we will also touch on tokenomics again a bit later. But maybe I don't want to generalize yields, but maybe what are the yields that you observe? Because I know there's big differences. Let's say, for example, let's take some blue chip assets like USDC or Wrapped Ethereum. What would be according to you guys a yield that would be obtained in DeFi on these two assets, for example?
Super cool question. I think maybe to just help maybe the new joiners who are maybe a little bit new in the DeFi, I would maybe add 1 point to the really cool explanation from Marcos and Valentin. So if you speak about lending in DeFi, it's like peer-to-peer lending. Maybe that's for new joiners and the blockchain is really important. So it's like what Marco described, everything was super correct. But what we try in DeFi, of course, is that we don't want to have a bank in the middle of it. So what you're doing in the end is you lend money or cryptocurrency to another person, more or less directly. So, and then Marco taught us all of the right use cases at the moment. Why are those use cases maybe relevant at the moment? Because still at the moment, and maybe that's interesting to get your opinion on that, it's difficult, for example, to use something like DeFi lending to buy real estate at the moment. So what we have at the moment in DeFi and lending are use cases that are completely in the digital space or most likely for trading. So maybe that's interesting to compare it to traditional finance at the moment.
Yeah. So Christian, you asked about like some cool numbers on some tokens. I think it's a very difficult question to answer, but we can get a little bit closer to it if we shed some light on a broader spectrum. Like yield in DeFi generally follows a risk return correlation, right? The more risk you engage in, the more you are rewarded for it. So let's just say we want to land USDC or Ether on a blue chip protocol that is battle tested, that is just well known, has high safety scores on, for example, DeFi safety and so on. So let's just say the least risky protocol, that would be, for example, Aave or Compound. I think we are moving between, I don't know, 1% to 3% for USDC, and for Ether, maybe even a little bit lower. I'm not sure, but it's very low currently. So, but once you're moving to, let's just say more experimental blockchains, more experimental protocols, then you can get rewarded for a USDC lend, maybe even 20% or 25%. It really depends. If there is, I don't know, a liquidity mining event or in general, maybe, just an event paying out protocol native tokens. So I think that's very, very important to know that there is high amounts of yield still in DeFi, but you have to relate it to the risk that is involved in the particular strategy to make sense out of it. And what you really want to find is an asymmetry between that risk and return, right? You want to find the best risk return ratio, and that could be on, I don't know, Kronos. It could be on Origami Finance, but it also could be on Aave or Compound. So it's constant monitoring and depends on a lot of factors from the market.
Mm-hmm. And as you said, Thomas, these strategies can be quite complicated once you dig deeper, or can become quite risky. So there are also tools in the DeFi space which will do the work for you. And one of the blue chips is, for example, Yearn Finance. And this protocol lets users deposit their assets, for example, stablecoins or other volatile assets. And those are then deposited into liquidity pools by Yearn itself across DeFi to provide the best rates of returns for users. So popular vaults of Yearn Finance product borrow stable coins to farm yield, but the farmed tokens get exchanged then to the user's deposited asset and paid back as yield. So it's kind of an asset manager in the DeFi space.
And maybe to add on top of the risk reward, there's also subsidies, let's call them like that, like yield farming. If a protocol wants to pull users to on their side, they reward them with tokens. One example could be Origami. So you have like first the risk level and higher, and then you have additional rewards to bootstrap the protocol, which it comes at the cost of the token at the end of the day, because if you are in a bull market, it's fine, you can sustain the price of the reward token, but if you're in a bear market, you then suffer from the high inflation you've had in the past.
I think this is also like a very good example on what we have discussed here in like I think like 2-3 months ago, when we had like the fallout with Terra, because as you just said it, like a subsidy, right, like a marketing expense to attract capital. I think this was also exactly what Terra was doing when they were offering this 19% yield on depositing UST. And I think we are now here at a very, very nice topic, because I think also Masoud said that before, that essentially a yield in DeFi can be split into two components, like also obviously like the leverage, but like the two like main sources is like, I would say, A, like fees generated by user activity. So let's say, for example, I swap on Uniswap and I have to pay a certain fee to the protocol, and this get then redistributed to the liquidity providers. And second, the issuance of reward tokens. I think this was also what Thomas was just mentioning when he said, for example, yeah, you can obtain 20 or 30% yield. Am I correct, Thomas, that this is not activity driven, right? This was also referring, I think, to reward tokens.
Yeah, exactly.
Mm-hmm. Yeah, and then I think let's touch a little bit on the reward tokens, because very often we see protocols offering like very high yields. I would say like up to 30, 40, 50%. I know recently you mentioned origami, for example. I know that there's some looping process where you can get easily to like 70%, and it's like with USDT and USDC, so two assets which are not very risky, I would say. Is there like a disadvantage or like a downside on basically receiving the main yield source as like reward tokens, or would you say there's even some advantages of maybe rather receiving reward tokens than, for example, fees, activity-driven fees from, for example, users?
I really have to think about advantages, but let's stay with the disadvantages for a moment.
Okay.
They can be of different sort, right? Protocol rewards you can generally think of it as inflation. So you have a certain inflation rate, and if you don't have a comparable capital inflow buying the token at the same time, token prices continuously go down from the reward tokens, right? And in a bull market, reward-driven yields are definitely more attractive because you have a lot of capital inflows that compensate for the inflation of the token, depending on the specific inflation rate. But yeah, I think that's a major drawdown, because sometimes if you enter a farm, let's just say you provide, you land on origami finance. Let's take that one. Then you get a lot of rewards, but you can't swap them immediately. You can't sell them immediately because they are subject to a vesting schedule, right? So that's one of the problems that are present right now, that you typically cannot just sell the rewards whenever you want to the current market price. And that makes it a lot more difficult to calculate, because all those rewards tokens, or many of them, come from experimental young projects, and you don't know if they're around in 1 or 2 years, right? But if you have a 1 or 2 year vesting schedule, you just have to trust the process. You just have to trust that they're still around. And if it's a good project, it might make sense for some people if they're really, really bullish on it. But in general, from an investor's perspective, or from a professional investor's perspective, it's not very interesting, because there is a lot of risk and uncertainties associated with it. As far as the upsides, I think one potential upside, touched a little bit on what I just said, could be that you're very, very bullish on a particular project, and you can just farm their native token because you want to invest in them anyway, right? So that could be a good case. Many people do that with Liquidity, for example. It's not a lot of yield, but it's a secure protocol, and many people are bullish on it. So you put some stable coins in a stability pool, and you get the protocol reward token because you're bullish on it, and you're fine with just having it in your wallet and wait.
So completely agree with you, Thomas. So one upside could be also, one reason DeFi projects launch tokens is to give ownership in the protocol to users. So they are giving out governance tokens. And after all, this is decentralized finance, right? So token holders want to have a say in the governance of the protocol and to be able to vote on key decisions. So issuing tokens is one important way for DeFi protocols is to establish that they are truly decentralized, right? So, but the problem is, as you also mentioned, when the system, The problem is on the way down. So the problem is that the yield farmers are mostly, or what we have seen in the last years, are not genuine users of the protocol, right? So, and chances are that they don't care about it at all. Their focus is about making money. And this means it will come to a point where the yield farmers are satisfied with the gains and sell their token rewards. And this crashes the token price and causes panic among the speculators who also sell. And suddenly then there is more supply than demand for the token, which further tanks the price and consequently its yield. And that's the big risk. So actually mostly there's no liquidity left.
Mm-hmm. So let's hypothetically say I'm new to crypto and I'm interested in building like a little portfolio of tokens. And I could just buy, like, let's say, for example, tokens at, I don't know, FTX, Binance, like a popular centralized exchange. And then I have the choice to, for example, either opt for something like Bitcoin, where I, for example, know that there's already 90 million tokens minted and that there's only like a few left, which has like a very long emission schedule. Or I'm just like, well, I would like to take a little bit more risk. And for example, I invest in a Curve, or like, let's say in Convex, or there's like quite many farm tokens, I think they're called, which are now also available at centralized exchanges. Theoretically, I mean, in the bull market, I guess it would be maybe still profitable, but in a market where it's trending sideways and I'm just holding these kind of tokens, for example, in a Binance wallet or like at another exchange, I would be subject to inflation. Am I understanding that correctly?
Yeah, I think if we're talking about tokens that have a reward mechanism behind it, and the token supply is continuously increasing, that's definitely sort of inflation. And if there is a net inflation, really depends on capital inflows at the same time, right? If there is a lot of people buying the token and driving the token price up, hypothetically, inflation bringing it down, you could zero out possibly your inflation, but yeah, it really depends on supply and demand.
Mm-hmm. Because this is always something where I feel like many DeFi investors or users are not always fully aware on basically what are like the tokenomics behind the token that they're actually holding. So let's say I know currently we have roughly 10% inflation in the Eurozone, also in the US. So essentially, while I'm holding USDC or Tether, this coin is also subject to this kind of inflation, right? We call it a stable coin. However, at the same time, if I'm holding, for example, Curve tokens in my wallet and I'm not, for example, locking them or staking them, like also what I think Valentin described before, it was about Escrow, I'm essentially like lowering my percentage, right, of like the tokens I'm holding compared to the other investors, for example, who are then willing to, for example, lock them for like a longer period of time, right? So I often feel like that this is something that's very difficult for the users to always like understand and to really grasp, that like, well, maybe this coin is like paying me out 30, 40, 50, 60%. That this is not always just like purely like yield that is paid out to me, let's say, for example, in a stable coin like Tether or USDC, but that is also refers to of like how many more tokens are actually being issued, and then somewhat explains like the inflation, right?
Right. Yeah. And actually, this is a very interesting point. And I have looked into it a little bit deeper, and there's also a table which we maybe can share on the panel notes afterwards, which looks at some coins, so I guess about 50 coins, and their token emissions and compares them to the previous all-time high. And just as an example, if we look at just arbitrary example, if we look at Lux, which is an NFT marketplace, and the previous all-time high was at $7 with about 800 million market cap and a circulating supply of 100,000 about. Right now, after within 1 year, they had a circulating supply growth of about 300%. And that means that at a price of 180 in comparison to $7, which was the all-time high, we will have the same market cap again. So, and this means in return that you will need far more money to get to the previous all-time high US dollar dominated price in comparison to before, because it's diluted, as you said, right?
Mm-hmm. Correct. And I think we already touched that a little bit before, but like this solution, let's say like this like issuance of like more and more tokens, which always drives prices down, is still very important for the DeFi protocols, right? That they have like this kind of mechanism. Maybe like you could also maybe quickly explain that to the audience, like really again, like why, for example, curve rewards, I think is something that has been like a very, very big topic with like, for example, curve wars, on like why it's so important, and maybe also like the vote escrow was like voting. Maybe like once we basically go through like the mechanism, so that people also understand that basically how is yield created, and how basically sometimes also how it's basically related to the native or to the governance token.
So if you have, for example, Curve as an example, Curve gives depositors the trading fees from the platform, but further intensifies its liquidity with the distribution of governance tokens. So yeah, so that are two forms of yield that users get from supplying Curve protocol, right?
Mm-hmm. And I think they can also essentially, with their voted escrow curve tokens, I think they can also decide on basically which pools are, for example, incentivized, and by that get additional reward tokens on top, right? Like, because this is actually where it becomes then super interesting. So usually, let's say this pool would get 1,000 curve reward tokens, but then the people who have created their vote escrow tokens, right, then they can vote. They can, for example, say like, hey, we would like to boost, for example, the yield for a specific trading pair, make the rewards even higher, let's say 30-40%, and by that attract more and more capital, and then make this liquidity pool like liquid, right? And so like it's really interesting to see that like this native token as a yield has, for I would say, investors, quite some downsides, especially also what Thomas had said before, right? With like this locking mechanism, and like that you have to wait and vesting, but also the DeFi protocols are desperately like in need of such a mechanism. Because you have also mentioned that before, that you would like to talk about that Olympus DAO was like one of the biggest topics in the last year, and I know that like the yield, just alone the yield made this protocol like super duper popular. I think it was sometimes up to 50,000%. Does somebody of you guys like to explain on what Olympus DAO was essentially doing?
Yeah, so they I mean, they're still around. So for me, they're not a product of the past. They have still a really good team. But what they intend to do is to build up a decentralized reserve currency. And yeah, they have bootstrapped liquidity with a very special mechanism, what you just touched on, 50,000, 100,000%, I think, in the first couple of days. Absolutely ridiculous. And they did that through what we call a rebase mechanism. So people were paid, I think, every couple of hours, every 8 hours. I'm not sure anymore. Every couple of hours, a fixed percentage on, more or less fixed percentage on their investments. And yeah, that high number was simply inflation, right? Because they paid out their own token. So that was a very interesting concept, and it worked pretty well for a couple of months because, and I've said that earlier, we had tremendous capital inflows at that time. So that was I think around November, December last year, right? That's when it became really, really popular. And that was the top of the bull market. So there was just huge amounts of money flowing into degen projects. There was so many rug pulls because everyone thought, well, this one is going to be my shot, and I stop working tomorrow. And so everyone put capital into all different kind of projects. And Olympus DAO was one that attracted a lot of people because it's a great number, right? If you see 50,000%, you do the calculations in your head, and probably not for the next days. So you think, oh, if I can run that for the next 1 or 2 or 3 months, that's pretty good. But yeah, the pitfall is that that APR is calculated based on the current token price. So under the assumption that the token price stays constant, right? So whenever you do your calculation, you have to basically adjust it for inflation. And to be honest, that looked very, very bad. So during the, as I said, a huge capital inflow period, that can make sense. And some people made good money with it if they managed to exit it on time. But most of the people actually were just exit liquidity, right? Being too late. Token dumped very, very badly. Same happened to Wonderland. Same happened to other rebase projects such as Klima DAO. Same thing.
Mm-hmm. Yeah, I've heard by many people that said something in the way of like, Olympus DAO is dead. It's a failed project, and I think it's always very, very unfair towards the developers because it's not their fault that like essentially the investors couldn't fully grasp like the tokenomics behind like the concept, because essentially, as you said, it's like they have a treasury, they have a rebase, they basically have somewhat like a type of inflation, and yes, there is this kind of yield. We could argue whether it's misleading, right? I mean, for like some investors, it probably was misleading. However, they still have like a function, let's say, for example, Olympus Pro, where you can have like bonding, like protocol-owned liquidity. So there's a lot of things that also came up with this, right? And I think like also how you said it before, I think like one issue might have also been like the premium, right? Because at some point, I think it was 2 to 3 times the market cap of like basically the treasury holdings, right?
Yeah, exactly. If you look at such a project, you say, well, the treasury is worth an amount X, right? And so the market cap of that project that owns the treasury should be about the same value. And so it, as you say, it traded at a ridiculous premium. But the question is why? And I think one reason is fear of missing out, right? And that people don't do the calculations correctly. But the second is that I think many people think the Olympus team is a very good team, very knowledgeable, that have very good strategic ideas. So I think a lot of people thought that project would develop beyond what is just happening with the decentralized reserve currency. So adding further revenue streams, adding different products and so on. So I think the premium also was just a trust in the team behind it. So, but that's exactly one of those discussions that need to be held, because everyone was talking about a premium, about treasury value, and it was such a new concept, and it showed how difficult it is to value new projects in DeFi if they come up with a really innovative mechanism. It's really hard. You don't have models prepared for that, right? So you have to kind of take standard models and build them around it, adjust them, and that's hard.
Let me add something, a few other thoughts. Like, I haven't followed Olympus since March, and I'm not sure there are like many news around it. It went not completely dark, but I guess they're focused on bringing a new roadmap, maybe to like scope the future of the protocol. Recently, I wrote that somebody is already suing the founder of Olympus, but I'm not sure. But let's say if the growth of Ohm token supply does not always outpace the drop in price because of the high inflation. So, but we can't say that the project is bad or some kind of Ponzi, because we saw so many copycats that failed, of course. But if somebody copies your project, then there's something interesting behind it, and it's worth looking into it and maybe improving it in the future. So yeah, let's see what the future holds for Olympus.
Mm-hmm. Actually, Thomas was also mentioning a very nice word called trust. And from trust, I would like to shift the conversation a little bit toward also risks in DeFi. And Thomas had also before explained, and I think also Masoud and also Valentin, about like risk rewards, in the sense that obviously the riskier the protocol, the higher the yield and the rewards I can obtain. What are like for you like typical DeFi risks, or let's say also blockchain associated risks?
Maybe I can jump into that. So maybe to name just the major one, of course, market risk. So you're always depending where the market is at the moment is heading. Then I think we mentioned that a lot is liquidity risk. So how liquid is the protocol in the end? I think we mentioned already lockup periods. So most of the protocols you cannot just unstake it for example, or you can end, for example, at every day your lending period. You have mostly reward duration, so even if you get your reward at a specific date, sometimes it's limited if you can swap it at this day, or you can sometimes you have to wait maybe a week, a month, or even a year until you can get into another token. Of course, if we speak about staking and validation, if you don't have your own validator, there's a validator risk. You have to trust it, and at the same time, you have the validator cost. The person or the company who's providing that service wants to have money as well for that. And yeah, the most mentioned topic maybe in DeFi or blockchain is always you can lose everything. There could be a hack of something, and maybe something that the developers haven't seen before, and that's a big risk all the time.
Mm-hmm. Somebody would like something to add?
Yeah, sure. So I mean, there are a lot of different perspectives on risk, right? You can look at, for example, the protocol layer. You can look at the asset layer, at the blockchain layer, and I think that's probably the one that makes the most sense that you think about. So if let's just say you follow a particular investment strategy, you have 4 layers of risk. You have the blockchain, the protocol on top of the blockchain. You have the assets involved, and then you have risks that are specific to the strategy you're deploying. And essentially, if one of those levels defaults, the whole position defaults, right? So in the end, you have to identify, measure, assess, and then mitigate risks on every level. And ideally, you come up with some kind of risk score for each level. And then because of the default risk, if one level defaults, everything defaults, you have to multiply those risk scores to make sense out of it. Maybe just a quick example on every level. Strategy level could be, I think Masoud mentioned Yearn earlier. You really have to know what Yearn is doing with your funds, right? If you deploy into a Yearn pool, you have to know what is happening in the background. In what kind of strategies are these funds deployed? How often do strategies change? To how many protocols am I exposed? Or for other strategies, is there significant liquidation risk involved? Things like that. Then on the asset level, that's particularly interesting for stablecoins because you don't want your stablecoin to depeg, right? You want a safe stablecoin that has some peg accuracy, and so you have to build frameworks to assess the risk of a depeg for a certain stablecoin. So USDC is centralized, independently audited, but also your funds can get frozen, right? But then on the other hand, you have decentralized alternatives such as DAI or LUSD, or even algorithmic stablecoins such as UST, and all come with different risks and different advantages. So you have to be very clear about that. And then on the protocol level, we talked about smart contract risks. Right? There's a risk for hacks, for bugs, but even the front end as well. Many people forget that front end also needs to be decentralized ideally, right? Because I think it was Curve that had a problem, not specifically with the front end, but with their domain. So many people transferred their funds to an attacker. So that's a very, very large risk indeed, that can be insured though. So there's a huge let's just say huge industry growing in terms of insurance. But then also governance risk, right? We've talked about how a DAO functions a little bit, and token concentration is a big issue, right? Who's managing the DAO in the end? And even if it's not token concentration, what's the strategic direction? If I deposit liquidity into a Uniswap pool and suddenly the Uniswap DAO says, well, we take a fee cut of 10 or 20%, it's a risk for your investment strategy, even though not a very bad one, but you still have to consider it. And lastly, on the blockchain level, we have proof of work versus proof of stake, right? We have number of validators, node softwares, documentation, testing, so all kind of different categories that provide you some good information on how secure a certain blockchain or ledger is. So typically, Ethereum is still by far the safest one out there, according to all criteria that you can measure. The less safe ones are, for example, Phantom. What's also okay is, for example, Avalanche and Optimism. I think they tend to be around 70-75% according to DeFi safety. Ethereum is around 90%. But you really need to be careful, because not every ledger is perfectly fine to send $1 million funds to it and just play around. In practice, it's very easy, right? You send your funds over and everything works very fast, and you think, well, that's a great chain, but you still have to consider the risks, even though it's not fun. It's not fun because I really love Phantom, and I would love to deploy more capital to Phantom, but there are significant downsides in terms of security. So in the end, you're not deploying as much as you would like.
Yeah. So actually, thank you, Thomas. You covered almost everything. Just to add a small point to that, when speaking about yield and focusing on yield, there are some important questions that you need to ask yourself. Like, for example, if there is a product market fit. So it's important that the people are using the protocol regardless of the market conditions or the token incentives, right? Or, for example, that the product or the protocol generates on-chain revenue through its product. You have to look at the revenue and assess if the operating expenses and the token emissions are larger or together are smaller than the revenue. And and lastly, you have to ask yourself if they are paying in sound money, like, for example, some popular choices are ETH or some stable coins. So speaking about yield, those are also some important questions to ask.
Yeah, actually, this what you just said, Masud, reminds me a little bit on Abracadabra, which is like also a lending protocol. And essentially, when you visited their Telegram or their Discord channels, it was every week the same discussion. Can we beat the emissions with the revenue that we make with this protocol? And the sad part is that Abracadabra also makes money with liquidations, which essentially meant that they started to beat the emission schedule. So basically, the revenue were higher than the emissions, when crypto really started to dump, right? And basically people were losing. However, it was good for the protocol. But yeah, I think this is a very interesting thought that you just shared. And because like all of you guys are very well, I think, aware also of like where traditional finance companies are standing right now, would you say that they are already having the infrastructure of easily mitigating these kind of risks, or do you still see it as like, yeah, it's very let's say not risk, but rather, let's say, uncertainty, so it's not very measurable and it's very difficult to really say, okay, what could happen? I mean, I guess none of you guys were also thinking about Celsius failing, Zero Arrow's capital failing. This was for me something where I really felt like, if even these guys, like, who are specialized also in knowing risks in crypto, can like move so quickly in the wrong direction, are we maybe still very, very early with like DeFi and institutional adoption?
Yeah, for sure.
Yeah.
I mean, in the end, it's just a game of probabilities, right? So you have different kind of scenarios that you model. You set your liquidation prices accordingly, or your collateral ratios. It's a game of probabilities, and it's always in the context of your risk appetite as well, right? So, but what's a bit worrying is that there were no. I mean, in the case of Three Arrows Capital, no one knows how exactly things worked in the background, but it's a little worrying that you don't have a process to add collateral or deleverage your position according to recent market developments. Not sure how they exactly got into that situation, but probably the risk appetite was a little bit too high. Probably some sort of revenge trading involved as well after the Badger DAO hack. But yeah, we're very, very early. I mean, there is not one person that can say, well, I have a very nice risk model that works with a 99.9% accuracy. And so I think that the most important thing is to think about systemic risks. How dependent am I on certain things happening in the market, and to prepare for tail risks. I think the industry is very well developing in that, because you can buy insurance, you can buy more hedging products than weeks ago, months ago. So I think that's a very, very good development, but still more traditional firms are very, very far away from being able to invest and from wanting to invest as well. And I mean, one might be the reason for the other, right?
Yeah, thanks.
I completely agree, Thomas. Yeah, I completely agree, Thomas. So I think we have a great perspective on that topic, and I speak a lot to banks and asset managers who are much more in the traditional space as a really big players in the traditional markets, and I would say they are far away at the moment. They are looking at it, they're interested in it, but of course you need the knowledge in the company. They have a good knowledge about risk and how to manage risk, but of course crypto DeFi are really new topics, and I think it would take maybe 5 or 10 years where they're really coming into the space. Of course, we see something like Celsius, but of course they're not just such as established like for example Deutsche Bank or Commerzbank or some other asset managers. So I would say they're interested. Maybe they're trying to get more knowledge, for example from consultancy companies. But I think it's more a strategic perspective, and we are not in this implementing phase that it's coming in the next 1 or 2 years.
Mm-hmm. Yeah, actually, yeah.
Maybe adding a few thoughts on this. Well, I'm not expert on banks, but I'm pretty sure that they can't take that much risk compared, for example, to Celsius. So because of regulation, and I guess Celsius issued a number of large loans backed by little collateral. On top of that, maybe the collateral was only crypto, Bitcoin, whatever, which if you have a pyramid of the quality of collateral, the bottom will be US Treasury bills, the most secure collateral you can ever have. And then Bitcoin is somewhere on the top, very risky. You take little collateral, you loan money to people, and one day they come after you asking for their money, I guess. So it's a very risky business model. And because of the freedom they have, taking so much risk is not possible if you're a bank. You'll get fined, basically.
Yeah, I agree. That's you mentioned everything, right? Regulation and how much risk they want to take on, because in the end, what we see sometimes with a DeFi protocol doesn't work. The person who maybe deployed it is changing the country, or you don't know the person. Maybe in a bank that cannot happen. You know the CEO, you know exactly what kind of person made the decision, and of course, at that point, nobody in a bank would say, let's do it. They think about risk, they think about regulation. And yeah, so we need more time in that space. But if I take a look at Thomas, I think there are some other spaces outside of banking and maybe traditional markets where new players are coming.
Yeah. Maybe just to add one more thing, that it's not particularly related, but I think it's very interesting. So 3 Arrows Capital engaged in collateralized and over-collateralized and under-collateralized lending, right? And so a lot of people and institutions lend actually money to 3 Arrows Capital. And they did that on very traditional processes. They were looking at the finances, right? They were looking at the team, and the default risk was probably not too high, looking at all these traditional factors that you typically involve when making a decision to lend out money. But I think what was really forgotten is to actually analyze and reflect on how that money that you lend is going to be used. Because what they do is it's essentially kind of a negative external effect, right? Because you have to trust the risk management of 3 Arrows Capital if you lend them money. And risk management in DeFi is very experimental. So in my opinion, I think under-collateralized lending has also be kind of, or the decision-making process has to be adjusted, because you can't simply trust people that they're doing their risk management right. You have to know what they're doing with the funds and have to analyze yourself what the actual risks are behind it. Yeah, so I think there is still a long way to go.
Mm-hmm. Yeah, actually, what I just also was thinking about was like what happened with Tesla, right? I mean, Tesla last year, the rising star, investing in crypto, probably also somewhat also initiating a further bull rally, and then suddenly, yes, Bitcoin became just a major risk to them. And they were, I think, I'm not sure, like, does anybody of you guys know how much they sold? I just know that they started selling. I'm not sure if they sold everything, however.
I think not everything,
75%, right? 80%, something around that. 75, 80%. But I think it was not just because of risk. I think what was really important for Tesla was the ESG topic. So that's only what I heard from newspapers and some articles, that asset managers, so ESG, of course, and sustainability is a really big topic for companies at the moment. And that's maybe a completely different topic than we have today. But is cryptocurrency and, for example, Bitcoin now sustainable? Or if a company is taking Bitcoin on its balance sheet, has that some negative aspects on the ESG score? And that's really important for a company if they get money from the big asset managers and investment firms, for example. And if, for example, Tesla doesn't get this money, like a growth company, that could be really bad, or maybe for just they have to pay, for example, higher rates or something like that. So I think maybe that was that kind of reason. And on the other hand, of course, Tesla is not like a bank or anything, so it was maybe more like, I think, a really good marketing turn of them. I personally believe in the long term they will do something with it, but I completely understand from a company perspective that they bought Bitcoin again, or most of it.
Mm-hmm. Yeah,
because of regulation and risk, everything what we mentioned.
Yeah, I agree with you, Marcel. Actually, this would be a very nice topic for another panel discussion on Because we just talked a lot about governance, right? And crypto is about empowering the investor and also maybe basically giving him, I mean, with stocks, you also have a say, right? We have like voting rights. However, with DeFi, it's still, I think, way more open to what all can be decided on, right? With like stocks is, I think, a bit more limited. But yeah, maybe we can talk about this like in a future panel to maybe like shine some light on like the environmental part and at the same time the governance part, because I think these are like two things that you always have to take a look at separately. However, for today, we're coming to an end. And I would like to thank all of you for being here today. For me, it was like a super interesting discussion. And I hope also that our audience has enjoyed the panel discussion for today. It will be available on the YouTube channel. So in case you tuned in a little bit late, you can just watch the recap. And then I wish you guys all a very nice day and a nice weekend, and see you soon.
Thank you all. It was a pleasure.
See you.
Cheers. Bye-bye.
Bye.